Hello traders, hope you are all doing great. And in my previous video, and in fact, if you see for the last 2 or 3 videos, also I have been telling I'm going to stop trading, or I'm insisting you also to stop trading. And many people are commenting, you should have taken that strategy, you should have taken this strategy, PE, CE, Delta, that, this, and all. I'm not denying it is correct. You are correct. And one guy is telling you should have taken a strangle, OTM strangles, and you will be in good profit. You know how much risk is taking a OTM strangle? And I can tell you, strangle is one of the riskiest strategy out there. One small gap down, you will see the effects of strangle, and you will see how much damage a strangle can do to your capital. That's because there are many armature traders, right? Post-COVID, there are many retailers coming into the market, and they really don't know what is happening, and they have not seen a crash, right? If you have seen a crash, you will not talk like this. I have seen a crash. I have seen a crash in March 2020, and I can tell you how much damage it has done. I have lost more than even you could think. And see, I can lose 1% of my capital or 2% of my capital. Absolutely fine. There is no problem in that. We can recover 2%. But losing 20% or 25% of my capital is very bad. I cannot afford to lose 20 or 25% of my capital. Even 15% I cannot lose. See, what will happen is once you lose a major chunk of your capital, it is going to take time for you to recover that. The loss which we made in 2020, it took us almost a year to recover that losses. That is why we are saying we can lose 2% or 1.5, 1% or 2% of our capital, but we cannot afford to lose more than 15 or even 20% of our capital. That is why we are not willing to trade in this uncertain times. You have to remember that it is not about trading. You don't have to be smart every time. You are not smarter than the market. Markets will kill you if you are trying to be over smart. That is what we are saying. And even yesterday I posted in our Telegram group, don't we have closed our position in all our trading account, and we advised to be cautious also. And look what has happened. Yesterday, day before yesterday, Dow fell 600 points. Yesterday, Dow fell another 300 points. And this Russia-Ukraine thing is creating uncertainty in the market. Not only Russia-Ukraine uncertainty is happening, there are more factors. There are more negative news in the market which could cause a crash or which could cause a deep correction in the market. Let us see what are the 5 reasons which could bring the market down. You know, since Nifty bottomed out in March 2020, investors have been treated to historic gains. It took less than 17 months for the widely followed index, which is Nifty and Bank Nifty, to double from its closing low during the pandemic. Further, Nifty has yielded a return of over 23% in the last 12 months. Returns stand at a stunning 52%, and from the lows of March 2020, an unbelievable 114%. Can you believe this? Nifty has rallied. Retailers are inside the market. They are pouring the money inside the market and taking the market higher and higher. But history has told you it is not going to happen. If you see the history, you have to pay the price for this. This volatility, crashes and corrections are normal part of trading cycle, and how much you don't know this kind of price action or don't know the cycle what is happening. So we will have to pay the price for this. Unless these things are settled, we are likely to see a highly volatile move, right? So the thing is, if there is a bull cycle, there should be a bear cycle. There is not going to be a bull cycle every time. Market is not going to move in one direction for years and years and years. And the Reliance is not going to be going to go from 2,500 to 3,000, 4,000, 5,000. It will correct, and that is what is happening. Whatever the signs you are seeing, or maybe the catalyst of a crash. So that's what I'm saying. So these are the things you have to see. The first point is the spread of the spread of new COVID-19, right? Since Nifty has gone more than 53%, and for your information, Nasdaq has appreciated only 13% or 40, not 13%. 23% or 25% for the last 12 months, but Nifty has appreciated more than 53%. That is a super high valuation. So let us see what are the catalysts or what could be the causes for a deep market correction. First thing is the spread of COVID-19 variant. You know, there are many variants. First it was COVID-19, then Delta came, then Omicron came. Now they are telling Delta Omicron. And I don't know, even I saw a news article where US is having various new variants. So the COVID-19 variants arguably the most glaring concern for the Wall Street, right? It continues to be the coronavirus and numerous variants, right? That unpredictability, these are the unpredictability of the spread of new COVID variants, strains, means a return to normal is still a potentially a way far. With every country, India, Singapore, UK, US, seemingly having its own approach to tackling the pandemic, what is going to happen is, due to this pandemic, supply chain issue and workflow disruption could remain commonplace for the years to come. So we are not going to see the 2018 or 2017 again. So you have to remember this: market likes certainty, and COVID-19 has ensured that a practical impossibility. Markets, I'm telling you again, markets like certainty, it doesn't like uncertainty. But COVID-19 has ensured that a practical impossibility of 2018 or 2017, right? So that is our first point. And the second point is historically high inflation in growing economy. If you see this thing, US and all, last week, they came with a high inflation, right? So inflation in a growing economy is very bad. Moderate level of inflation, let's say for 2%, are perfectly normal. However, 6.8% or even 7.2% increase in consumer CPI index, I think 7.2% CPI inflation in January represented a 40 years high in the United States. When the price of the goods and service rises rapidly, business and consumers usually aren't able to buy as much as their disposable income. Thus, high inflation has a tendency to slow the market and encourage Reserve Bank of India to tighten its monetary policy. Maybe in coming days, we might see Reserve Bank of India increasing their interest rate. So what is going to happen is, it is going to be very hard for companies to borrow capital. It is going to be expensive to borrow capital. So when it is going to be expensive, nobody is going to borrow capital, and economic activities are going to come down. That is the reason. That could be a reason why we are saying market can go into consolidation or deep correction. It is not going to touch 18,600 anywhere soon, and I have posted a video about this, that if market touches 18,600 during this during this quarter, I will quit YouTube, and I don't think I'm going to quit YouTube anytime soon, right? And the third point is hawkish Fed. You know, the Federal Reserve. The third reason the stock market could go into consolidation or deep correction in 2023 is the Fed turning hawkish. Even though we live in India, it's very important for us to follow US market, which is the mother market. For the past 13 years, the nation's central bank has promoted dovish monetary policy. Or let me put it this way. it has kept lending rates at or near historic low and undertaken numerous quantitative easing initiatives designed to bringing confidence in the housing market and weighed down long term treasury bond yields, right? Beginning into 2023, the Fed is going to wind down its quantitative easing program and will likely raise rates by 22 basis points on couple of occasions. So even last week, this Federal Reserve chairman came out and told they are going to increase the rate. So as access to ultra cheap capital, right? Since the interest rate are very low, it is very you are going to get a loan for very low rate. When the interest rates are increasing, ultra cheap capital becomes expensive, right? The expectation is that overall economic growth will slow. That's what we saw in the second point also. If Reserve Bank of India is going to increase their interest rate, it is going to be very hard for companies to borrow money. It is going to be very hard. It is not going to be very hard. It is going to be very expensive for companies to borrow capital. So if they are not borrowing capital, it is going to be they are not going to expand their businesses. So this is the very simple thing. And the fourth thing is, which is local Q, right? Local Q is 5-state election. Now there are elections in 5 states: UP, Punjab, Uttarakhand, Manipur and Goa. Out of these 5 states, BJP is in power in 4 of these 5 states. Any decrease in this number is also going to dent the market sentiment. You have to understand, right? That is also a big thing, right? So if BJP, we don't know how the numbers are going to be in coming days. If the numbers are going to be very low, if BJP is just able to get power in 2 or 3 states, means that is it's not about politics. I'm not going into politics, but that's not a good number. From 4 to 2 or 3 is going to dent the market sentiment also, right? So that's one point you have to keep in mind. And the last but not the least is Russia-Ukraine issue. Now this issue has been around for some times now. Russia doesn't want Ukraine to join NATO, but the Biden administration want Ukraine to join NATO. This is creating a panic in the market, and as I talk to you, Russia has in fact added troops to Ukraine border. I'm not sure when this is going to finish, but still then we are going to have a patchy ride. So all these things tells us that markets are likely to go on the downside and there is no upside. So maybe, of course, I'm telling you with a disclaimer, maybe you can go and sell 18,600, 19,000 or even 20,000 call option. Markets are not going to go and touch 18,600 or 19,000 or even 20,000. So once I told that markets are, maybe it is going to touch 15,000 and I don't know when it is going to happen. Even I will tell you, even if there is any good news when it comes to Ukraine-Russia issue, market might bounce back slightly, but it is not going to touch 18,600, 19,000 or even 20,000. The likelihood of touching 18,600 or 20,000 is very limited. So that's what I am trying to say, right? So with all that being said, trade cautiously, trade properly. Even if you trade with a proper hedge. Don't take naked position which will damage your capital. So that's it. Nothing much. Thank you for watching. Take care. Bye.